Hi, this is Blair Tushaus, partner here at Tushaus Wealth Management, here to give you a economic and market update as we are approaching the beginning of August. Currently, it is July 29th. We are waiting on the Federal Reserve decision, where approximately two-thirds of the vote or the predictive market is saying the Federal Reserve will unchange, meaning they're not going to raise interest rates or lower interest rates. But there is some skeptics out there that are saying they may increase the rates. And although that is the minority, um, Citadel and some other companies have projected rate increases. How does that affect the consumer economically? Simply put, we raise federal rates. Trying to curb inflation. We're seeing costs of goods kind of creep back up, but that may affect mortgage rates. Mortgage rates have already risen. They could rise further. But really, a Federal Reserve Warsh will use that tactic to keep interest rates and mainly inflation at bay if there is that type of fear. Now, everyone's been talking about cuts, cuts, cuts for so long. When are they actually going to happen? Well, if we only had a crystal ball. But today, besides economically, I want to talk about the market, the QQQ or, what we call, tech or high growth, the major companies, Mag Sev, those are now in correction territory. QQQ, as I look at it right now, is at 666, which is well off the highs into correction territory. But one thing, we promote and try to educate people is that during midterms, we often see high volatility. Now, you may hear the term seasonality. Seasonality, despite midterm year or not midterm year, there is more volatility in certain parts of the year. The fall or the springs, sometimes we see the volatility index, VIX, VIX, spike up during those, February, March, April, and also August, September, October. Those are historically when VIX may pop. When VIX pops, VIX is the measurement of how volatile the S&P 500 is. So right now, as I see it on today, which is Wednesday, July 29th, VIX is just a hair under 20. That's relatively high, but not, the highs we see during COVID or global financial crisis where it popped up all the way to 80. What it does tell me is that with the VIX creeping up, we should expect some more volatility unless we get significant reassurance in the market, which so far we have not seen. So with volatility, that VIX index creeping up, we should expect in a midterm year as we approach seasonality, which is that fall. So it's kind of a double whammy. We have midterms year and the seasonality part coming together. We should expect high volatility this fall. Doesn't mean the market can't, go much higher. We hope it does. But at the same time, we're not going to be oblivious to historical data and how the markets react. So VIX is high, something to be alert of, something to be aware of. Now, there's two ways that I want to speak to how we solve that. Primarily speaking is defined outcome or buffer ETFs. I've talked about this in the past. It's a way to keep your money in the market invested in those indices like the QQQ, the Dow, the S&P 500, but put some type of protection on it. We can get 100% protection or different variations of that. Why is that important? Because if you're currently exposed to the market, and the market does drop further, you get all those losses, just like you get all those gains. We have certain positions out there that can buffer against those losses, 10, 20, even up to 100% buffer against market losses, but participate in the upside. Maybe we get half the market gain, maybe we get 80% of the market gain. But there's so many different variations that we can create for our clients. It's something to be aware of. This is the number one used um, solution during times like this. We can't simply be out of the market. All right. Money on the sidelines is not going to do anything for us. Money in cash is going to barely keep up with inflation. We can at least put it in something that has protection. I'm not going to go on the highway without my seatbelt on, without the airbags working, without four wheels and four doors. Want to be safe, in case a crash does happen, but I also want to not be too afraid to get to my destination, get in the car and drive. If there's some bumps, I'm protected. If you want to learn more about those type of solutions, feel free to contact us, reach out to us, and we'll be happy to have that conversation. In addition, there are other ways we can solve for market volatility. We've been having the discussion about annuities with our clients. There's different types of annuities, just like there's different types of cars. There's a specific type of annuity that we would typically recommend over the others. A fixed index annuity has 100% protection against market downside and normally can participate in the upside. So when the market does go up, we're getting better returns than opportunity cost, which is, on the sidelines or in cash. So that's a way to, again, similar to the buffer ETFs, participate in the market, protect on the downside, eliminate unnecessary fees, and in addition, in some cases, can create guarantee income. That's not necessarily what we're talking about today, but fixed index annuities as well can do those same type of um, can solve for those same type of issues. So between the buffer ETFs, fixed index annuities, these are the solutions we look for in times like this, in times of, okay, VIX is rising, I'm going into or in retirement, and I can't see my principal drop 10%, yet alone 50% like it has in the past. If we go through another dot-com to Great Recession, what we call the lost decade, 2000, 2012, that's 13 years of sideways movement in the market. You add in distributions because you need to live on your retirement. So one could find their nest egg being depleted. So those are the things we have to solve for. A lost decade, a bad sequence of return. What if this is the start of 3 years, like the dot-com, or even 12 years of a new lost decade? How is your portfolio going to handle itself? Is it going to have that protection? Is it going to have secured growth? And at the end of the day, um, is it going to keep you up at night? So not literally at the end of the day, are you going to be able to go to bed and feel comfortable with how you're invested? And I'll end with this. The great Warren Buffett says, buy low and sell high. We've seen market highs just crush over the past couple years, and now's the time to start protecting your principal. If any of this is of interest, reach out to us. I'll provide information below to email, call, or reach out to our website. So, anyways, today is Wednesday, July 29th. Who knows what's happening in the next 2 days? We'll see how the Federal Reserve reacts, and we'll go from there. I hope you all have a great rest of your week, and we'll talk to you soon.